Good day, fellow investors. In this video, I want to share with you my feeling about the stock market now. I know a lot of you will love this video. We'll discuss the key factors for long-term investing that are related to the market: P/E ratio, dividend outlook, risk and reward, and how the situation confirms what I am looking at and the factors that we are discussing. So let's immediately start with the price earnings ratio. Now it is 24, but compare that to the historical average of around 15, you are paying about 70% more than whoever you heard about talking about investing in the last 100 years did. You are really buying and investing now, which is relatively the most expensive period since like ever. So that is the stock market now, and that's something you have to keep in mind when it comes to investing, but also to comparing to other investing opportunities. A P ratio of 24, 25 means that you will likely make long-term 5% from the stock market. Compare that to your 7% student debt loan, then you know, okay, I better go for the lower risk paying off the student debt or something like that instead of buying this. The rent you're paying is 6% of the house, you might think about buying. So that is for comparative reasons. The market is now stretched and on the expensive historical side. Further, if we look at 10-year average earnings, the Shiller P ratio, only once in history it has been that high, twice, okay. Dot-com bubble, minus 50%, Great Depression, minus 86% for the market. The Fed and everyone is doing whatever they can to prevent such crashes, but the reality is that long-term returns, when the CAPE ratio is close to 30, will be around real returns around 2-3%. Nothing great, but also nothing terrible if you average over time. As Warren Buffett always suggests, okay, you can invest here in the index, but make sure that when it is lower, buy more. If you didn't average down and you are an index investor, if you didn't average down in October here and in March of 2020, then you are doing things wrong. Let me know in the comments if you did average down during those periods, also 2009, 2002. I did average down, so you can check my research platform if you're interested in my portfolios, my research on individual stocks. I do not invest in index funds. I look at the global market and try to find higher dividend yields than, for example, the current market gives now. Check it out, 21-day money-back guarantee, so feel free. I really appreciate it, even if you just check it out. So the P ratio of the stock market now is risky. And if we look at the dividend yield, I think it is even worse. So 1.63, while the historical average is 4%. People like to say, okay, this time is different. Is it? The Fed's interest rate now is around 4-5%. Treasuries are 4-5%. Everyone is expecting that to return to how it was 3 years ago. Oh, great, nobody cares. Whoa, low interest rates forever. What if it doesn't? What if this in 2 years is 4%? That's minus 70% for the index. I don't like this. And why I don't like this? Because when investing, if there is a risk, I would like to be paid to take that risk. 1.63 is not enough for me, we'll discuss it in a moment, to take the S&P 500 risk. This, in my opinion, looks risky and bad for now. And then let's discuss the outlook. We are now at 4,179 points for the S&P 500, but that also means that over the last 2 years, the S&P 500 did nothing except the 1%, 1.5% dividend yield. So 2 years already of nothing, and I think that this 2 years of nothing might be the case for the next decade. Now I'll explain. I think that the outlook is zero for longer because of the risks I just mentioned. So, if interest rates go higher and economies get weaker a little bit, margins get tighter a little bit, liquidity gets tighter, then everything could look much different. 30% down isn't much for the S&P 500, even if everyone would call it a crisis, but 30% down would be 3,000 points, which was the peak of early 2020 and then later in August again, which was the normality before the pandemic came and the worst crisis in our lifetimes, and the stock market is 50% higher than it was prior to that. Nothing prevents it to go back where it was, which would then give a little more normal dividend yield of just 3%, but no miracles there. So I think that there are more forces pushing this lower over the next 10 years than higher. So that's why also the risk reward is bad. If my reward, I don't know where will I get the 7, 8, 9, 10% that everyone is saying, oh, just invest in stocks, you get 10% a year. Yes, that was the case when the dividend was on average 4, 5%, and the P ratio was on average 15, plus some growth, you get to that 7, 8, 9, 10%. Now we are at historical high levels and people still expect the same result with completely different inputs. So anything can happen. There is always the reward. The S&P 500 can double in the next 5 years. Don't get me wrong, but just the risk and reward of the situation is not that attractive. It can go 50% down, most likely, but it can also double. Anything can happen. It's just about risk and reward when it comes to investing. And as I already said, over the last 2 years of nothing, that confirms that it is looking for direction, but that the fundamentals aren't there to justify going higher as long as the Fed prints money to save the banks and everything. Since the banking crisis, the index went even up. As long as that is possible, okay, it will hold its lines, but the risk of a shock is brewing and getting bigger. And also the fact that it goes nowhere shows that, okay, we might have reached the high plateau that a Fed chairman called it in 1999 or something. So be very careful about those high, long lasting plateaus that some people or the market is thinking it can hold itself. I hope it does. I hope the S&P 500 doubles in the next 5 years. Everybody happy, but the risk and reward simply isn't attractive. That's my view of the stock market. Of course, I look for individual businesses. You can check my stock market research platform. Thanks for watching. I'll see you in the next video.